The race has been called. Joe Biden will become the 46th president of the United States come January 20th, barring some unlikely twist of fate. He won't have an easy job in front of him. Biden will be inheriting an economy struggling to find footing in the midst of the second wave of coronavirus infections. Adding the uncertainty of a new administration into an already wildly uncertain environment could be a recipe for some choppiness. Today we'll check out the best stocks to buy under Biden administration. Number 7. Energy Transfer LP. You might have done a double take when you saw Energy Transfer LP, ET $5.11, in the Biden list. Energy Transfer is a pipeline operator, after all, and a particularly controversial one. The company is currently embroiled in an ongoing dispute over its Dakota Access Pipeline, which passes close to the Standing Rock Reservation. Opposing the pipeline is a cause célèbre for environmental activists. So, how can Energy Transfer be on a list with the likes of environmental darlings like Tesla? It comes down to cash flow. Under a Biden administration, it is safe to assume that new pipeline construction will slow to a crawl. The permitting process will become lengthier and more cumbersome. Given the election year, we believe that the regulatory environment would become more challenging under a Biden administration, as he could require lengthy reviews to determine whether a project's economic value outweighs its impact to climate change, Stifel analysts write. Paradoxically, this is good for many pipelines, particularly the large, established ones. Many operators have taken a growth-at-any-cost approach, looking to build empires respective of profitability. Unfortunately, for now, Energy Transfer has been forced to make a painful move in the interest of deleveraging and putting itself back on firm financial footing. That is, it cut its distribution by half, from 0.305 per unit to 0.1525, which you could argue many investors had already priced in, given its sky-high yield of nearly 20% prior to the cut. The upside for new money? That still leaves ET shares with a roughly 12% yield and allows the company to more aggressively pay off its debt. And without the temptation to spend cash on new projects under a Biden administration, Energy Transfer could eventually be in a better position to buy back units or even begin building its distribution back up again. Number 6. Brookfield Renewable. Renewable energy will definitely be a winner with Joe Biden in the White House. The president-elect has made reducing carbon emissions a top priority. A rebounding economy would also drive demand for energy production. As one of the leading renewable energy stocks on the market, Brookfield Renewable is in a perfect position to profit. The company's business has boomed even during the coronavirus-caused recession. Although U.S. electricity generation fell 5% and fossil fuel generation slid 10% earlier this year, renewable energy generation jumped 14%. Meanwhile, Brookfield Renewable's funds from operation, FFO, have continued to climb by double-digit percentages. Over the last 2 decades, Brookfield Renewable has given investors an average annual total return of 18%, with renewable energy more cost-effective than fossil fuels. Number 5. Intuitive Surgical. There's no question that the pandemic has hurt Intuitive Surgical's business. With hospitals operating at maximum capacity due to COVID-19 cases earlier this year, and again right now, elective procedures have been pushed back. Many of those procedures are performed using Intuitive's robotic surgical systems. But Intuitive Surgical will make a strong comeback as COVID cases decline. By the time Joe Biden takes office as president, there's a good chance that 2 vaccines will be available to Americans. Hospitals should also begin to feel enough confidence to resume capital spending, which would be great for Intuitive's sales of its Da Vinci robotic surgical system. More importantly, though, Intuitive Surgical's long-term prospects are exceptionally good. As populations across the world get older, they're more likely to require surgeries, and especially the kind of surgeries for which Intuitive's robotic systems are ideally suited. Intuitive also continues to innovate and expand the kinds of procedures where robotic assistance can be used. This healthcare stock is practically a no-brainer for long-term investors looking for reliable growth. Number 4. The Trade Desk. The COVID-19 pandemic has been a mixed bag for the trade desk. Sure, some advertisers reduced spending during the crisis as their revenue plunged. However, people watched streaming TV services more than ever before, which boosted potential advertising audiences for connected TV, CTV. As the leading provider of a software platform for companies to buy digital ads, the Trade Desk has been and should continue to be a huge winner from the latter trend. CEO Jeff Green said in his company's third-quarter conference call, "Advertising is an engine of economic growth, and our customers know that their campaigns can fuel growth and drive market share gains for their brands." Green's view seems to be on point. Over the long run, the increased adoption of CTV will provide a much larger market opportunity for the Trade Desk. The Trade Desk is a growth stock that's a great fit in nearly any investment portfolio. Number 3. Kirkland Lake Gold. A Biden presidency should also be generally good news for physical gold and gold stocks. Since the dollar and gold have an inverse relationship, this is a positive for miners like Kirkland Lake Gold. Of course, Kirkland Lake Gold is going to benefit from more than just a higher realized price for the lustrous yellow metal. Kirkland Lake Gold also has the best balance sheet in the entire industry. It ended the third quarter with $848 million in cash and no debt. Further, it's tripled its dividend in 2020 and repurchased $526.6 million worth of its own stock over the past 9 months. Number 2. Becton Dickinson. President-elect Biden is serious about getting the COVID-19 pandemic under control. In his view, there can be no durable economic recovery until the virus has been tamed. A major piece of that strategy will be the deployment of a vaccine once it arrives. And while it might not be fair to call this a Biden investment, given that the push for a vaccine started under the Trump administration, it will inevitably be the Biden administration that implements it. This brings us to Becton Dickinson, BDX 236.26. Becton, a dividend aristocrat, is a manufacturer of medical instruments and supplies, including syringes. If you're going to administer potentially hundreds of millions of vaccines in the United States alone and billions globally, you're going to need Becton and its peers to ramp up production of the equipment needed to make that happen. What's more, it's not at all certain that a vaccine is a one-and-done event. It seems that immunity to COVID-19 following infection and recovery can last as little as only 3 or 4 months. This would suggest that for a vaccine to be remotely effective, it will require regular boosters. Well, that's a lot of syringes, and Becton will be there to deliver them. Number 1. NextEra Energy. NextEra Energy, NEE $75.72, isn't the most exciting company on this list, or any list. For crying out loud, it's an electric utility. But unlike many of its peers, NextEra has a focus on renewable energy, which makes it interesting in the event of a Biden win. It's the perfect company to consider buying in a Biden bull market. What separates NextEra from boring utility stocks is its focus on renewable energy. No electric utility is generating more capacity from solar and wind power than NextEra. NextEra is delivering a nearly double-digit compound annual growth rate in a sector known for low single-digit growth. But it is best known as the world's largest producer of wind and solar energy, as well as one of the largest battery storage companies in the world. For an electric utility, NextEra doesn't sport a particularly high dividend yield at just 1.9%. Specific administrations can slow or accelerate the momentum, but the long-term growth story remains intact. That's why not a day goes by when you don't hear about IPOs or reverse mergers through special purpose acquisition companies, also known as blank checks, that are looking to play this trend. But that's just it. NextEra isn't a garden variety electric utility, and you don't buy it for the yield. You buy it because it is a leader in green energy and a stock that is likely to catch the eye of social responsible investors. Do let us know in the comments which one of them you're going to buy. Thanks for watching.